We note that all three major indexes moved higher since our last report, yet we continue to note some difficulty for the indexes to convincingly reach higher highs on the regular. In the current report, we aim to shed light on the fundamentals for US equity markets as a whole, but also particular issues for some high-profile companies staring down the barrel of the EU Commission regulatory body, and for a rounder view end the report with a technical analysis of the Nasdaq. The EU Commission on Monday announced that it has opened non-compliance investigation under the Digital Market Act into Alphabet's rules on steering in Google Play and self-preferencing on Google Search, Apple's rules on steering in the App Store, and Meta's pay or consent model. Should the non-compliance investigation opened by the EU Commission find the aforementioned companies guilty of violating the DMA, it could weigh on each company's stock price respectively. The possible repercussions could be very hefty fines, which is something the Commission has already shown a willingness to impose as a deterrent, which was seen by the 1.8 billion fine against Apple earlier this month. Therefore, the possibility of a future fine in addition to a potential loss of future revenue could weigh on their stock prices should they be forced to change their lucrative business practices. However, it should be said that the true impact on each company's stock price may be seen after the investigations have concluded in 12 months, and any current negative impact on their stock price could be only seen temporary. Lastly, on a smaller note, the EU Commission did also state that Amazon may be seen in contravention of the DMA and as such may warrant closer attention in the future should enforcement action be brought against Amazon. The equities market focus last week was on the Fed's interest rate decision, in which the bank remained on hold as was widely expected. Following the monetary policy decision, the dovish undertone that appears to have been struck with the new dot plot seems to confirm 3 rate cuts are due to occur this year. In addition, the relatively dovish press conference by Fed Chair Powell seems to have supported the equities market, as from an equities perspective, the implications of easing interest rates could facilitate greater revenue and growth opportunities for companies. However, we should note that the next big test for US equities could be the release of the core PCE rates for February this Friday. The core PCE rate is the Fed's favorite tool for measuring inflationary pressures in the economy. Economists are currently expecting the year-on-year rate to remain steady at 2.8%, which would imply persistent inflationary pressures in the US economy and as such could dampen the market's aforementioned hopes for easing monetary policy this year. On the flip side, the month-on-month rate is expected to increase at a decreasing rate of 0.3%, which would imply easing inflationary pressures, thus softening the potential blow to the US equity markets. Overall, we would place a great emphasis on a year-on-year rate, and as such, should it come in as expected or higher, it could weigh on the US stocks. Whereas a lower than expected reading could support the shares price of US-listed companies. Nasdaq on a technical level seems to have stabilized its price action near the 18,500 all-time high figure. The index appears to be moving in a relatively upwards fashion, having formed an upwards moving channel which was incepted on the 1st of March. Furthermore, the Bollinger Bands appear to be tilted to the upside, implying some bullish tendencies in the market. Moreover, the RSI indicator below our chart currently registers a figure near 60, implying some bullish market tendencies. We maintain a bullish outlook for the index, and for it to continue, we would like to see the index continue to validate our mentioned upwards moving channel, in addition to making a clear break above the 18,500 resistance level, with the next possible target for the bulls being the 19,100 resistance line. On the other hand, for a sideways bias, we would like to see the index remain confined within the channel defined by the 17,800 support level and the 18,500 resistance line. Lastly, for a bearish outlook, we would require a clear break below the 17,800 support level, with the next possible target for the bears being the 17,160 support line. As this report concludes, we would like to thank you for being part of our financial updates. From all of us here at IronFX, we wish you a solid trading.